Good morning again. If you're just joining us, thank you for joining this webinar on the applicability of exchange rate derivatives in Treasury and investment management, with focus on learning from global markets. We'll be giving just a few moments, maybe a minute or two more, to have a few more people join us, and then we'll be starting this webinar momentarily. As you can see, we have our panelists already lined up for you to give you their insights into this. Good morning again. All right, I think it's a fair time to start, to respect people who've joined us in a good timing. Could you just confirm you can hear me? Drop a message in the chat box. Let me know you can hear me clearly, loud and clear, anyone at all? Thank you, Rahim. Thank you very much for that confirmation. Okay, my name is Jumoke Olanyo. I head business development at FMDQ Securities Exchange Limited. I'll be your anchor for today and moderator for the panel session where we'll be discussing the topic for the webinar today. So as not to waste too much time, we're just going to go straight into the agenda. And to start off the day, we'll have our host, the Managing Director, FMDQ Securities Exchange Limited, Ms. Tumi Shikuni, give us just a brief word of welcome before we go on to today's session. Tumi.
Thank you, Jumoke. Good morning, ladies and gentlemen, and welcome to the FMDQ Exchange Traded Derivatives webinar session for end users themed Applicability of ETDs in Treasury and Investment Management, Learnings from Global Markets. FMDQ Securities Exchange Limited, that's FMDQ Exchange, started the journey to develop a derivatives market in Nigeria about 4 years ago with the activation of the FMDQ Derivatives Market Development Project to set the tone for and facilitate the launch of an active and viable ETD market in Nigeria, thereby introducing exchange-traded and liquid risk hedging products to the Nigerian financial markets, as is obtainable in other emerging and developed markets globally. With the prevailing volatility in prices, continuous fluctuation in market rates, and constant uncertainty of macroeconomic indicators in the financial markets, it is indeed the ideal time to introduce effective and efficient risk management tools such as ETDs to mitigate the adverse effects of market risks on the business operations, on business operations in general anyways. So leveraging on our aspirations to deepen the Nigerian financial markets and transform them to be globally competitive, operationally excellent, liquid, and diverse in line with our GOLD agenda, the preeminence of the FMDQ ETD market cannot be overemphasized, as it ushers the actualization of the panacea that will enable the development of thriving Nigerian financial markets like other developed economies and markets. As part of its mandate to empower the markets and one of the key activities of this project, FMDQ Exchange has executed a series of sensitization and engagement sessions with market stakeholders, ranging from regulators to capital market operators, banks, pension fund administrators, corporate treasurers to accountants, to mention just a few, to create awareness and promote readiness for participation in the FMDQ ETD markets. In the same vein, this session will be focused on discussing the applicability of ETDs in corporate treasury, fund, and investment portfolio management, and also hearing from model market experts on the use of ETD products for risk management and investment diversification in their regions. The launch of the FMDQ ETD market will indeed mark a critical and long-awaited milestone in the Nigerian financial markets, positioning them for the revolutionary growth in potentially colossal proportions. FMDQ Exchange plans to launch its trailblazing ETD market with the introduction of interest rate futures, particularly the Federal Government of Nigeria bond futures. I thank you all for joining this webinar, and in particular, I want to thank our SMEs from the various parts of the globe, discussing with us today. And I'm confident that this session will provide useful and insightful information about the use of ETDs, as well as avail all participants the opportunity to seek clarifications from the seasoned SMEs lined up for this session. Once again, thank you and enjoy the session.
Thank you very much, Tumi, for that opening and welcome address. At this time, I'm just going to introduce to you all our attendees, the panelists we have with us today. And as I said, I'm most excited to have each and every one of them with us here today because I believe they have unique views, unique experiences, and positions to share with us on the session today. I'll start with Johan Erasmus. Mr. Johan Erasmus is an executive in Standard Bank South Africa Global Market. He's currently tasked with crypto trading initiative and strategy for structured flow business in the Standard Bank Global Market. He is a founding member and executive director of One Invest, the Standard Bank Group's ETF and index tracking fund manager. Johan has fulfilled various roles across Standard Bank over the past 20 years, including heading corporate wealth sales and distribution, global markets client structuring group, and legal co-head for corporate and investment banking. He's a seasoned financial markets and banking expert and has worked with exchange-traded products, banking regulation, and legal matters, structured products, and derivatives across all asset classes. So you can very well see why we have Mr. Johan with us on the call today. Welcome, Johan, and good morning. Thank you for joining us.
Thank you, Jumoke.
Next on the line, we have Shiv Patel. Shiv is currently the head of fixed income trading at Rand Merchant Bank, South Africa. His role, he has a role he has held for the past 4 years. Prior to this role, Shiv worked as an inflation trader for more than a decade, focusing mainly on the South African inflation-linked market. He holds a BSc degree in actuarial science and statistics and honors degrees in actuarial science and advanced math of finance. Welcome, Shiv. We're so glad to have you with us today.
Thank you.
Thank you. Next, we have with us Jaron Mersin. Jaron is a fixed income trader at Absa Group South Africa, based in Johannesburg. He is responsible for market making, local currency FX, and interest rate derivatives across African markets. He has over 10 years of financial market experience, having traded a variety of fixed income and foreign exchange products and markets. He started his career at Rand Merchant Bank in 2012 and joined Absa in 2021. Welcome, Jaron, and thank you for joining us.
Thanks, good to be here.
Thank you. Next, we have Andrew Gillips. Andrew is currently the head of Tradition Futures in South Africa. This is an institutional brokering division of the Tradition Group, a JSE member brokering firm, which is focused on listed fixed income, foreign exchange, and commodity markets. He has been in the markets in both South Africa and USA for over 30 years. He was a brokering member of the Chicago Mercantile Exchange in their growth and emerging market division, where they launched and traded the first ever exchange-traded FX contracts in the Brazilian real, Mexican peso, Russian ruble, and South Africa rand. And then Andrew became a founding brokering member of FX Derivatives Division in the JSE in 2007. Similarly, Andrew in Tradition Futures is instrumental in the launch of African FX derivatives market within the JSE Currency Division, including the listing and trading of FX futures market in Nigerian Naira, Kenyan shilling, Zimbabwean kwacha, and all of them against the South African rand. Again, you can see why we have Andrew join us on this call. Andrew, thank you so much for your time and thank you for joining us.
Great pleasure, thank you.
And last but absolutely not the least, Mr. Sudhir Gyokar. I hope I pronounced that correctly. There is a seasoned finance professional with over 20 years in world-class multilingual and multinational companies in Asia and Africa across multiple finance-related roles. His experience encompasses developing business strategy, capital raising, corporate restructuring, treasury and currency management, risk management, among others. Sudhir joined Olam in 2012 as finance controller in Nigeria before moving up as CFO for Crown Flour Mills, a subsidiary of Olam Agri in August of 2017. He was instrumental in scaling animal feeds and protein business in Nigeria and integration of Boa Flour Mills, and later acquired and integrated Dangote Flour Mills Limited. Currently, Sudhir is the group CFO for Olam Business in Nigeria. And prior to joining Olam, he'd worked in various international companies such as Reckitt Benckiser, Henkel, and ABB Limited. Good morning again, Sudhir, and thank you so much for your time joining us this morning.
Thank you, Jumoke. Nice to be here.
Thank you. So to start the stage and the conversations, I'm just going to run through 3 slides that talk about derivatives, the risk management we see and risk we see in global markets, and of course, even in the Nigerian markets. And then that's going to lead me into questions around your experiences and exposures to derivatives markets generally. Chakwa, can you put up the slide? Thank you. So what we've looked at is we're trying to look at what is the ideal standard? How do we set up an exchange traded derivatives market that would be the ideal standard for all participants in the market? Today, we're focusing on corporate and end users which will involve corporate, asset managers, pension funds, and the likes. So to do that, like I said, I'm just going to run through 3 slides. Next slide, please. So, there's always been questions, facts, and myths. Next slide, please. There's always been so much questions around exchange traded derivatives. What derivatives as a whole? Did they cause the global financial crisis? What kind of derivatives or derivatives markets were implicated in the global financial crisis? How many clearinghouses failed during the global financial crisis? Are derivatives really weapons of mass destruction? And is it speculation? These are questions that will always come up no matter whenever the conversation around derivatives happen. And part of why we're doing the session today is, apart from just dispelling all of these myths by having persons who have actually used derivative contracts, and indeed the very specific one we plan to launch the market with, explain to us how their experiences have been and use those experiences to dispel this myth, we believe it's also going to enlighten our participants on the use and the benefit of exchange traded derivatives. Next slide, Tope. Case in point was the Lehman Brothers one versus its holdings, where they had over-the-counter derivatives that had about 96% of their derivatives in over-the-counter derivatives, and then they had exchange-traded derivatives about 4%. And while the over-the-counter derivatives had major challenges with resolution over a long period of time, history has shown that the exchange-traded derivative was cleared and resolved in a matter of weeks. So something must be right with exchange-traded derivatives. Something must have been going on well with exchange-traded derivatives. And we're going to hear a bit more of that when we have our panelists share their experiences with us. Next slide. If you take a look at global statistics, we can see how the statistics of exchange-traded derivatives against OTC derivatives is shifting and evolving. Futures and options products, which are the typical or most popular types of exchange-traded derivatives, have grown significantly over the last, 10 to 15 years by almost a CAGR of 10%. If you take a quick look at 2020 to 2021 figures, you can see how there's a huge change and move towards those kinds of exchange products and use of those products in exchanges. So all of this just buttresses the point that there is something, there is a benefit, there is a use for exchange traded derivatives and why they are that important. And that is part of the reason why we've set up this webinar today, to share with this community, which are end users, corporate, asset managers, and the likes, why exchange traded derivatives are that useful. So to start off today, I'm just going to ask to start with Andrew. Andrew, you are a broker, so you deal with a lot of these end users, you broker those transactions for them on the exchange. What has been your experience with the use of exchange traded derivatives in the GSC? And I mean, if you want to throw in experience coming from the Chicago Mercantile as well, we'll be very happy to have you share some of those points with us.
Thanks very much, Jamaki. Yeah, I think the markets globally broadly accept the usefulness and the need for centrally cleared and a central platform to trade instruments, be they derivatives or the physical underlying. Certainly, in my experience, both in Chicago and here on the Johannesburg Securities Exchange, this market has been embraced for a number of reasons, and I'm sure your audience will embrace and understand these reasons, and they're not new reasons. Having an anonymous platform is very, very efficient for price discovery. Having a centrally cleared and collateralized platform enhances the credit counterparty risk, which speaks for itself in terms of the development of a market. It also creates an incredibly level playing field, because typically the only barrier to entry is some kind of cash collateral, which is placed within the clearing architecture, or which again leads to level playing fields, better price discovery, which are all steps on the journey to a more efficient functioning market. So I think the success of exchanges worldwide and success of these products worldwide speaks for itself. If these factors weren't relevant, we wouldn't have these thriving markets. So I concur with you. I think it's a logical and natural evolution in the development of your markets that this development happens. The small nuances and differences between how exchanges are set up and how the clearing houses are established, I think is less relevant. I think the key factors are the central counterpart clearing, the publication of prices in a very transparent way, the reduction in barriers to entry. All of these level playing field initiatives provide a more efficient and a more fairly priced market, which is to the benefit of everyone. So, congratulations on this initiative. I have no doubt it will work. I'm not knowledgeable enough about the key attributes of the Nigerian bond market, but certainly at a macro or global level, speaking from my time both in the USA and back at home here in SA, these markets have thrived for all the reasons I mentioned, and I see no reason why the initiatives that you're starting in the markets that you are beginning there will not do the same. So that would be my observation.
Thank you very much for that. Can I ask Jaron Ashib, do you want to share your experiences as well in the derivatives market in Jersey?
Sure. I'm happy to go. Well, Jaron, you can go for it.
Okay.
Thanks. Yeah, I shared Andrew's sentiment. So as a market maker at Absa, I'm actually part of the team that market makes some of the derivatives listed on the JSE, including currency futures on African currencies, and I'm sure Shiv will also share some experiences around the South African fixed income market as well, and how the JSE listed derivatives support liquidity in the fixed income market as a whole. I suppose the example of African currency futures listed on the JSE is quite a good template as such for how markets tend to migrate from the OTC space into the exchange traded space. So the FX futures, for example, that are currently traded on the JSE don't see very significant volumes, but over time there has been growth in the market, and I think it represents the benefits of moving to exchange from OTC, and I think many of those benefits are the same points that Andrew outlined earlier. Transparency of pricing, at a more level playing field, and fewer barriers to entry in terms of getting access to these derivative products, which are sometimes quite difficult to access for smaller participants in the market. So if we look at the equivalent OTC market for FX futures in the sub-Saharan African markets, those are typically traded as non-deliverable forwards, which are an OTC product generally traded between large financial institutions amongst themselves. So various international banks trading them with each other, and with large corporates and large institutions participating in these markets. And these large players have access to certain OTC infrastructure, which is almost their ticket to access these markets. So that infrastructure will involve legal infrastructure, such as the ability to enter into ISDA derivative contracts with counterparties, operational infrastructure, which involves being able to value and calculate risk management measures on the OTC products, and in addition to that, to meet daily collateral calls from the various counterparties that you are trading with. And I think this represents quite a large barrier to entry into these markets, because it's only large institutions that are able to have access to this type of infrastructure. When you go and migrate these products onto exchange instead, the operational burden and the barriers to entry really do reduce. I think on the other hand, migrating to exchange does come with its own challenges, and I think some of these challenges are what's limiting the movement of some of these some typically OTC products onto exchange. I think one of the challenges is in less liquid markets, of which I do believe Nigeria probably falls into that category, in being less liquid than some of the more developed emerging market fixed income markets or FX markets. It's a bit more difficult to convince price makers to expose liquidity electronically and on screens, which generally encompasses a large proportion of exchange trading. So what needs to be done is to bridge the gap between OTC or bilaterally agreed trades, and then executing and settling those trades on the exchange. So an exchange doesn't necessarily have to mean that execution and trading of the products happens on the exchange. It can simply mean that settlement and valuation happens via the exchange, and actual trading can still be executed bilaterally via brokers or via from financial institutions to their counterparties and clients. And I think that's an important differentiator, and it's an important step in the process of migrating these type of products onto exchange. I think another important challenge, just to recognize, is that one of the factors that holds back international participants in local exchanges is their ability to fund margin calls in a local currency. So I think it's also important to consider from an exchange perspective the ability to allow international participants to fund their margin requirements in currencies other than the local currency of the exchange.
Thank you, Jaron, for your perspective. Shiv?
Yeah, look, I think Andrew and Jaron covered some very pertinent points. Ultimately, derivatives give you leverage. But with leverage, you then need to manage, small movements in the market can result in large P&L calls. And the benefit of the exchange is obviously it manages that credit risk through a margining process. And I think that margining process does, as Andrew said, kind of level the playing field versus all the various bilateral agreements that are in place in the OTC market. But with that comes the challenge. And I think Jaron touched on a very important point. In illiquid markets, where the price can move on very little volume, it can result in outsized margin calls. So in the South African space, we obviously we don't have an illiquid market. We have a decent liquidity in the bond derivative space, but we have noticed, during crises, large asset managers and funds had large bond futures positions on, but it led to large margin calls. And, the ability to manage that margin call is critical for kind of the stability of the system. So if insurance companies and large asset managers, they're capable of doing it, which is good, but even they struggle. And we noticed quite a significant migration from exchange traded to OTC, because the benefit of OTC is that you can enter into a lot of bespoke margining agreements. So instead of daily margining, you can have weekly margining, which enables them in a large overnight sell-off to at least give them a week to raise that liquidity in order to collateralize agreement. That's one factor. And and then non-cash collateral is another big factor for them migrating to the OTC market. Another very important point to kind of manage market moves is that obviously on the FX side, it's settled in the local currency in a non-deliverable format, but in the bond derivative space, which is the largest portion of the South African market, second to FX, is that they must be physically delivered. Because as soon as they're not physically delivered, it creates large delta positions for the sell-side banks who are effectively managing, because you write the derivative and you hedge it in the physical market. If the derivative cash settles, then you're still left with the physical hedge. Now you need to go liquidate the physical hedge. So I think that's an important characteristic. So I think ultimately, exchange trading makes sense. It opens it up to a lot broader market. But what is very critical is the ability of participants to fund their margin calls, because inability to do that can result in forced liquidations of futures positions, which obviously exacerbates market moves. So ultimately, with leverage, the problem then becomes managing credit risk. So it's an important consideration for those looking to get involved in exchange traded, that they're very aware of the ability to manage their margin calls. I think that's been an important finding, or locally, that was one of the big themes. And even recently in the UK, the LDI crisis where the Bank of England had to step in and kind of buy those bonds was because, large insurers, if they struggle to meet margin calls, bearing in mind they had a massive move in their market, it can destabilize the market as well. So I think that's the main point. But other than that, Jaron and Andrew covered some very important points.
Thank you, Jaron. Thank you, Shiv. Let me come to you, Johan. So who have you seen are the major players and users of your interest rates and bond futures in the JSE market? What are they using it for? What is it? Because for every derivative contract type, you can have it for risk management, you can have it for portfolio diversification, and the likes. What is the use case like for those participants in the South African exchange traded derivatives market?
Yeah, thank you. I think two of the main uses are financing on the one side. So what you would find is that a lot of our asset managers and end investors, instead of buying in the spot market and holding the underlying bond, they would typically then sell the bond and buy the future, thereby creating leverage in their books, as my colleagues alluded to, which is one of the risks. So what that then does is it frees up the nominal value of the bond for them to either invest in other assets or to provide other exposures onto their books. As Shiv alluded to, our market is a physical settled one. So at each closeout period, you will then be delivered your long bond again, and then we'll find that cycle repeat itself quite a lot. So that's the probably one of the main uses for it, especially in the bond side. On the FX side, there's ulterior, one of the ulterior reasons on that is as well as our exchange control, where we would find, so yes, there's finance and the leverage exposure, but you also get given the nuances in our market that allows foreign exposures through listing mechanisms, mean that that's the only potential way that you can gain exposure to those underlying asset classes. Of course, the other uses, as you alluded to in your opening presentation, yes, some clients use it for hedging, some clients use it for cheaper access and that. But at this stage, bond futures is definitely the major use is leverage finance.
Thank you so much for that. So Joe, let me come to you. Being a CFO, you've on various international companies across regions, Asia, Africa. Definitely you've used derivatives in one form or the other. I know we're talking about or skewed more towards interest rate derivatives today and the bond futures, which is what we're going to launch in the FMDQ markets. But can you just share from your experiences, how has it been using derivatives in any case you've used it? What was the motivation to use the derivative? What was your experience going through the process to engage the necessary broker, market maker, contracting on it, and running through a whole derivative contract tenor?
Correct. So thanks, Jumoke. So as you know, in Nigeria, we don't have this product at the moment, but we are thankful that in 2016, when the NDF market as a derivative market was established in Nigeria, we could participate a lot. And we could cover a lot of our foreign currency exposures, and that really allowed our company to bring in a lot of portfolio investment in the country, so that wherein we can hedge our exposures, currency exposures against those markets. So exchange traded derivatives are widely used in our organization. We primarily use for our soft commodity also. When I say from a soft commodity perspective, like we buy cocoa and we hedge it under London Stock Exchange at the moment. So we have traders based out of London at the moment, wherein they support us to close those positions. So as I think all the panelists have spoken, it is easier for us because it helps us in supporting our credit risk, our counterparty risk, our currency exposures. So that goes a long way for our corporate stability with respect to risk management. So rightly said, we have been using as our organization. We have not in Nigeria. We have certainly not used the bond traded product, which you are rightly stating. But as an exchange traded derivatives, yes, we have rightly used with respect to commodity and currency. But yes, we would be more welcome to use it because today in our country, we don't have a product for our interest rate hedging. So I'm sure at some point of time, we will have those products wherein we can have OTC contract with bank, wherein we can take use of this product to support our long-term funding in NGN.
Thank you very much for that share of experience. Andrew, let me come back to you on that. How much, how important do you think the role of the CCP is in the adoption of any exchange traded derivative product, you would say? I know we've heard Jaron and Shiv talk about margining, illiquid markets and the move and how that can impact, the exposures any of these participants would face in the ETD market or exchange traded derivatives market. I mean, give us your insights. What do you think, or how do you think the CCP can be positioned? What comfort does it give to any party that wants to participate in that market? What should be looked out for by any party that wants to participate in the market?
Actually, I think it's the foundation of the exchange. I think without it, you don't have an exchange, you don't have a market, you don't have liquidity, you don't have anything. So I would say it is the most important thing, without dismissing the exchange's role in disseminating information and providing good IT platforms and publishing information. The essence of any derivative, any market that is not Delta One or physically cash settled, is the underpinning of the credit counterpart. So in South Africa, we have a grouping of clearing banks that collectively and in aggregate provide the underpinnings and the guarantees on the exchange. So practically, just for your audience, when you transact on the JSE, your credit risk is not to the JSE. The JSE is merely a vendor of data information and a provider of a platform. Your credit risk is the joint and severable balance sheets of the clearing houses that are party to the exchange. And my understanding is that your exchange will operate in a very similar fashion. So, I don't think it's a massive conversation. I think without a robust clearing counterpart at a balance sheet level, whether it's a trust fund underpinned by the various clearing banks or whatever the legal structure may be, the viability and the success of the market will be determined by the viability of the clearing houses. And there are lots of examples of this in Africa, and I don't want to mention specific names or specific exchanges that have failed, but their failure wasn't because of IT, it wasn't because of smart people, it wasn't because of innovative products, it wasn't because of time zones. The reason why other exchanges have failed is because the market perceived the clearing and capital guarantors to those exchanges to be insufficient, and therefore no one participated. And so an exchange is a funny thing. You need participants, on both sides of the fence, both the price makers being the banks and the various end users. And so to keep it brief, to answer your question, I think it's a chicken and egg thing. Without that infrastructure surrounding the exchange, there is no market, full stop.
Jumoke, can I add on to that? Because I was particularly involved with Lehman's as well. Standard Bank had both OTC and derivative risk and to add on to what Andrew, there's a massive responsibility, one, on the exchange to mark the product fairly. So both in determining the initial margins, but that VM margin is crucial on a daily basis, so that is as marked as true as possible. And the reason for that is, as Andrew said, is fundamentally at the end of the day, the clearing member carries the risk of its trading counterparts and that. And while we've never had losses across our clearing system, all the losses that's occurred in our market has been on a clearing member's perspective, that one didn't exercise enough credit oversight over its own trading member, where this trading member would have put on a position with another trading member, but this clearing member, its clearing member, didn't apply proper risk management. And you often find as Shiv and Jaron mentioned, you find a big movement there, and your trading member is left without collateral, and that then sits on your clearing member, and that's where the losses are taken. So it's those two elements are key to the system.
Thank you so much, Andrew and Johan, and Johan, sorry. So, I mean, just sort of bringing together what you've said, and for the audience here today, the choice of your trading member and how they're monitoring your positions on a daily basis, and how all of that cascades up to the clearing member and, of course, to the CCP, very important factors when you're going to go into exchange traded derivatives. Very good points there. Thank you so much. Shiv, let me come to you. The South, I mean, I've mentioned it here, maybe in passing once or twice. The product we are looking to go live with or launch is bond futures. I mean, interest rate futures, long-term interest rate futures. And if we look at the statistics in the South African market, the bond futures market has done very well. I mean, it's one of the highest, I believe from statistics, it appears to be the highest trading interest rate future in your market. Statistics show it growing tremendously, at least as of Q3 2022, about a 16% growth from the same period in 2021. You know, the value of interest rate products traded rose 11%, 92% of that coming from, you know, interest rate futures. What is the driver that has made the bond futures and interest rate market grow in South Africa? What 1-2 key points do you think has helped that market grow significantly?
I think Johan touched on it. It's a very structural market. I mean, for a long time, we've hoped to have two-way flow, you know, where there's natural buyers and sellers. You know, you have the speculative, you have the hedgers, you've got the different players creating two-way flow. Unfortunately, that's not the case. It's a financing market. So effectively, as Andrew said, the asset managers are trying to generate additional returns by leveraging. So they buy the bond future, which means they effectively are long the bond because it's physically delivered, but they long it at a small interest rate cost of whatever the financing rate is. And against it, they buy credit assets. So that's what's driven the success, shall I say, of the market. But ideally, you want two-way flow. And, you know, I feel like the two-way flow comes in when you bring in external participants. But as Jaron said, the challenge is they don't, it's a struggle for them to finance margin in local currency. They would much prefer hard currency margining terms. Because then they don't need to physically buy bonds in the local market, and they don't need to fund it in the FX swap or in the repo market. They can just trade the future, and then it becomes a healthy market, two-way flow, people taking views on bond views and interest rates. Where should government bonds be trading? At the moment, that's not the case. At the moment, it's a financing market, and that's why it's been very successful. If you look at traditional, what we call JIBAR futures, you know, that's another form of interest rate derivative. The reason that didn't take off or has had limited success is more because our OTC market is so well serviced by local and international banks, and allows significant flexibility in the types of views you can take. And in addition to that, it's a different form of clearing, but those derivatives are now LCH cleared. So you can choose all sorts of bespoke stuff and then just clear it via LCH, whereas a standardized product on the JSE limits you to you know, those tenors for trading. So we've seen less success there, but, you know, as regulations change and require us bilaterally to have initial margin, you know, under our CSA agreements, which are under ISDA, then it creates a tailwind for exchange trading products because now the playing field is leveled. The OTC market margining terms, in fact, become more onerous because you might be long with one counterparty and short with another, but you got to place initial margin with both. Whereas on an exchange, it will see you as net zero and won't require any initial margin. But again, I think LCH, the ability to clear on LCH and the bespokeness of the interdealer market means that that market is possibly going to continue to have headwinds, just because though there will be locals who will start playing in that market. So yeah, we'll see how that develops. But ultimately, optically, the market looks very successful, but it is not in an ideal state, shall I say, on the JSE.
I mean, thank you very much for that, Chief. 2 points you raised there. First of all, obviously, being able to use exchange-traded derivatives brings some form of capital and collateral efficiency as against OTC derivatives. But I wonder then, your point about, having two-way flows by having foreign participation, can that be said to be the expected growth path of the start of any market? You're going to have your domestic, first of all, start that market. And as it grows, it gets stable, it gets efficient, it grows bigger, then you would have the third parties come into play. And, then the next level of the growth of the market would be experienced. Jaron, can I ask you, what role did regulation or the regulators play in the success of the bond futures and interest rate market in South Africa?
I think, Jumoke, that's an excellent question. And I think in the South African experience, from what I understand, the buy-in to the kind of evolution of the local financial markets from our regulator, which in South Africa, for these products is a combination of a division of the South African Reserve Bank and the JSE, which does have some of its own regulatory jurisdiction over the financial markets. I think the buy-in from those authorities and the interaction between the authorities and market participants in the evolution of the markets was absolutely critical. And I think it's important to view the futures market as part of the overall market ecosystem that exists in a local financial market, because there are various components that rely on each other. So, for example, in bond futures, the funding of the futures contracts to some extent relies on an efficiently functioning repo market for the underlying bonds in that financial market. So I think it's important for the regulator to be involved in regulating and providing the framework for all the underlying building blocks that exist, and then to also provide the oversight to ensure that the different pieces of the ecosystem interact with each other efficiently and in a way that enhances financial stability. I think in the South African example, if you look at it, we've got, as some of the other participants mentioned, we've got quite strict exchange controls, which are important for stability of our local financial system, and the implementation of those controls and the policies behind them are constantly evolving as a result of interactions with the private financial community and the regulators. I think as I touched on earlier, the building blocks need to be regulated by the regulator, but also I think there's a role for the regulator to, especially when the regulator is a central bank in a market, to play their part in supporting the growth of a market, especially in the early stages. So in the South African experience, the regulator was much more heavily involved in the development of the repo market and in participating in the repo market in its early stages, and to some extent that gave the market the boost that it needed to ultimately stand on its own 2 feet and function as a very efficient market. And I think in South Africa we probably have one of the most efficient local currency repo markets across all emerging markets, and it's probably largely due to the support that the regulator provided to that market in its early phases. And I think if you relate this to the Nigerian market, I think there's a lot that the Central Bank of Nigeria can do to promote efficient funding markets in the local financial markets. I think one thing that they can do is to enhance the implementation of monetary policy, so that there's a closer connection between money market yields and the policy rate. And then another thing that they can do is also to potentially participate more actively in local money markets and repo markets to enhance the growth and to promote the growth of those markets, which will ultimately lead to deeper and more liquid financial markets, which are going to benefit the economy as a whole.
Thank you for that. I mean, I think we've also been lucky to enjoy that at the start of this market. When I asked Andrew about the question about the CCP, the impetus to even have 2 CCPs established in a year came from our regulators putting the right law and the right regulation in place, on the back of we also having the appropriate law, the netting provisions and law put into place. And in a spate of 2 years, since those 2 key pieces of legislation and regulation having been established, we can see the results. We now having getting to the point we're able to establish standardized and proper exchange traded derivatives market. So before I come to Sadir, I'm going to ask the colleagues from South Africa one question. Do the PFAs use these products in South Africa? How much of it do they use? Because I would imagine they're exposed to so much interest rate risk in the assets under management. Do they use these products? What is the framework around they being able to use these products in the market? I don't know, maybe Johan, you want to go, or someone else can go as well.
Yeah, so Jamaki, our market is around pension funds, and that is quite different to Nigeria, insofar as South Africa has the pension funds, which they then have asset consultants, and they generally farm out the management of their assets to dedicated asset managers, where Nigeria, the structure is a bit differently. And then it's, as we alluded to, it's within these asset managers that they then use the derivatives for, or the exchange traded derivatives for leverage and financing in order to get some better return in that. The nuances, and as the regulations are changing and derivatives requiring more collateral on an OTC basis, fund managers generally don't have that capability to when they're managing different funds. So an asset manager in South Africa can manage as much as almost 100 funds or sub-funds at any given time. And then for them to move collateral on an OTC basis on that base becomes near impossible. And that's sometimes why they then prefer to go and do that transactions on a clearer, where you then got a financier at the back of the clearer in order to remove those type of, let's call it, administrative burdens, plus adding the finance and that. So yeah.
Thank you. Interesting. But I mean, what I hear is there's benefit from it, even though, I mean, the structures are slightly different. They're using the product in an indirect manner. There's benefit, to the PFAs and the kinds of risk their portfolios are exposed to. So let me come to
just a 2-second, or just
yes, please, Andrew, go ahead.
Just to corroborate and add to Johan's point. There's no doubt that that the listed derivative markets are embraced fully by the domestic asset management industry, perhaps not as fully as they could or should, but one of the overriding reasons is the regulatory permission, or the regulatory environment that allows that makes it not a massive headache or a big heartache for a broad asset management community to hedge on an exchange. So to the degree that you are removing potentially quite substantial OTC credit bilateral arrangements, you enable asset managers to use the exchange because it's the path, or the path to use the hedge is just that much easier. Whether they use it or not is a separate debate, but you've certainly created an easy route to market. Then you have all the secondary considerations around education and market knowledge and applicability of the solution, and that's a separate debate. But just to add to Johan's point, to the degree that your exchanges are permissioned, encouraged, and well regulated by the various bodies that regulate the asset management community, you are certainly opening a lot of gates to allow the individual pension fund or portfolio managers or asset consultants to use those hedges. So there's no doubt that it has that net positive effect on the environment.
Thank you so much for that, Andrew. Simplified processes would definitely always have benefit for capital market transactions. Thank you. Just before I go to Sujay, I was just going to mention to participants, please, if you have questions, please put the questions in the Q&A box. We're about coming to that section. I see one question there, but if there's any other question, please put up the questions there. Sujay, let me come to you. Having heard all of this, what all the participants have said, and I'm sorry, the panelists have said with regards to the use of derivatives in their markets, the challenges, the factors that have made such successful, such a market successful, the potential for the further growth in the market. What do you think the introduction of these FMDQ products will further, do you think it will further help you with your own treasury management and investment management for corporates like yourselves? I guess the point is, what is the extent of your exposure to interest rate risk, and how do you see this come into play to significantly help you manage those risks that you carry on your balance sheet?
I think it goes a long way for our business. Like, in our business, we are highly leveraged, and it goes a long way because as we see today, there is no product in Nigeria which really allows us to hedge our interest rate risk. As some of the panelists have stated at some point of time, like, the CCP plays a vital role in having that stability, that environment being placed. And, at few years back when we had the currency market being created, like an NDF market, the strong CCP really enabled the country to have a faith in that NDF market, and people participated in that. So I believe having a strong regulated CCP market with very well placed documented governance system, which is known to the entire world, and it is simplified, it is understood, it is well governed, really goes a long way for a corporate to use the product to hedge the risk and all. I think all companies globally or in Nigeria would certainly make use of it, because today if we have to go for any long-term raising of funds or for long-term assured returns on any of our product, there are no means to hedge those risks, and that really create an averse in this market, both from the bank side and also from the corporate side, to really participate on. I think this will really go a deep way to really have a strong founding pillar for this.
Thank you very much, Sudhir. We look forward to you being one of the pioneer participants in that market when we launch the market, of course. Yeah, we'll be watching out for you there. So we're going to go to question and answer quickly. I have one question here from Pabina Yinkere. It says, to what extent does the introduction of ETDs help to improve market liquidity? Any gleanings from other markets, how this transpired? Does the liquidity of the underlying have any bearing to how successful the ETD becomes? I'm going to leave this open. Anyone can choose to answer this question.
I think maybe I'll jump in there. I think the example I think of in this regard is obviously the world's largest bond market, US Treasuries, and what you see is that US Treasury futures actually become the benchmark of the price for the pricing of yields and fixed income products, and everything else in the financial market trades around that. So to get more specific, the main source of liquidity for interest rate risk in the fixed income market, and the market where a participant has access to the best possible interest rate pricing, are the Treasury futures. And then the underlying US Treasuries and the bonds themselves actually trade with reference to where the futures are trading. So I think that's a great example of how definitely the availability of futures has enhanced liquidity in the overall market. And it's even gone to the extent where the derivative market has overtaken the cash market in terms of overall liquidity.
Thank you, Jaron. That was a perfect example. So I hope that was a good answer to the question we had. Are there any other questions in the house? Well, I think not. So what I'm just going to ask is last words from everyone on the panel. As we foray into this, as the FMDQ has, gone ahead to do the work of documenting, structuring an exchange-traded derivatives market with the learnings from all the other markets. I do tell you, we learned a lot from South Africa and the GSC markets and the players as well. And even learnings from other markets, good and what not to do as well. What are your last words for us, the FMDQ, as we define, the FMI, the financial market infrastructure that is establishing that? And what are your words for the end users who this product will now be available to them to use? Just last words, quick last words from everybody.
Yeah, sure. I'll jump in just because I need to excuse myself.
Yes, please. Thank you.
Congratulations on this initiative. I have no doubt it'll work. Just one thought to the exchange provider, and we had a brief chat about this off-air earlier. I think in the fixed income space, a very key component to your offering pertains to relative risk rather than absolute risk. So in the fixed income markets, people are not always so concerned about the absolute level of interest rates, but rather the term structure of interest rates between short-dated and long-dated interest rates. So to the degree that you can make it efficient, clean, fair, and transparent, how participants can hedge relative price moves, let's say between the 1-year point and the 10-year point, to the degree that you can enable and facilitate those, I think you will be, well, first of all, I think it's an opportunity the market will embrace. And secondly, I think you will be doing yourselves a lot of favors around introducing and encouraging liquidity. I'm sure Shiv and Jaron are better placed to chat about this than me, but a not insignificant part of the liquidity on the JSE activity and flow pertains to relative activity, relative fixed income views as opposed to absolute. So it's just a cherry on the cake. It's an aside, or it's an additional thought and point, but certainly it's a big factor in our market. And I'm not knowledgeable about your market at all, but I can only assume that it may have a lot of resonance for your asset management and pension fund and liability-driven communities to have an efficient way to hedge relative interest rate risks as opposed to just the absolute price risk. But congratulations, and I look forward to watching that exchange grow from strength to strength. Thank you for the invite.
Thank you so much, Andrew. And yes, indeed, Andrew had already mentioned he would have to leave. Thank you so much. We really appreciate your time and the insight you've shared with us this morning. So
Pleasure.
to others as well, last words?
I'll go next, if you're
Okay.
okay. Yeah, I would say, obviously it's great that you're learning from all other exchanges and countries and stuff, but every market has its own story. And my general view is that whenever an initiative like this is in place to try and make things better, depending on where different markets are, it's always a good initiative. And I'm sure it will be successful, just given the factors that are at play in Nigeria. So that would be my first message, that take learnings, but go on your own journey. And please do experiment and do these sorts of things because they can generate value. And then to the end users, my only message is please be wary of the margin call.
Thank you, Shiv. So I guess this is why we're educating them all, over and over and over again. We've been running a series of training sessions so people understand the markets and how they work properly before they get into it. Okay, thank you, Shiv. Anybody else? Next.
Yeah, I suppose I'll jump in there. I think as someone who's got some experience trading in the Nigerian fixed income markets, I have to say it's out of all the fixed income markets across the continent, it's one of the most dynamic and exciting when it does get busy. So I think the introduction of fixed income futures is really going to be a really useful tool for local investors and also for potentially foreign investors to access the market. And it's from our side at ABSA, I think we're very excited about the upcoming launch and very excited to participate and trade in the market.
Thank you so much, Jaron. Again, so I've got two people I'm looking out for when we launch that market. We're definitely going to be excited to have you guys on.
Sure. So I'll go next.
Yes, please.
So I'll go next. And I think, Jumoke, all the best for this launch of this new product. I think this is going to go a long way to corporate like us, wherein we will be able to hedge our product and we will be able to pass on our idle liquid funds which we have in Nigeria to make the most of it. Because today when we look at it, I think this is one real clean product which is missing, and it will really deepen and smoothen the curve of the interest. Thank you.
Thank you so much for that, Sudhir. Thank you again. Johan?
Thank you, Jumoke. Yeah, thank you. I think this is an exciting development for your market. I can only see it growing on it from strength to strength. And as the FMDQ drives to develop the local market, and both for local investors and foreign investors. So no, good luck. And I think it's going to be a very, very positive product and well received.
Thank you so much, gentlemen. I had one last question that came in. For us PFAs, what is FMDQ's plan to help bring PenCom on board to allow us manage our interest rate risk with exchange traded derivatives? Well, I guess that's directed at me or FMDQ. We are indeed engaging the PenCom, the Pension Commission, the same way we've engaged participants to, educate, sensitize about the structure of the market, challenges in the market, the risk management which the CCP brings to place, and the comfort of the protection, for pension funds coming into that market. We've done exactly the same with the Pension Commission. So we're in talks with them, we're in engagement with them to, get them to that point as well, where they're comfortable with the pension funds being able to use this product. So let me throw a charge back at you, the PFAs who are on the call. Join us on this, engagement with the Pension Commission to jointly, sensitize them about the use of exchange traded derivatives, especially for interest rate risk you're exposed to. I mean, just for the panelists, our pension funds are exposed to fixed income, about 60 to 70% of assets under management and government securities and interest rate type securities. So this is an asset or a kind of product that they definitely need to be able to hedge whatever risk they hold in their portfolios. So we're doing that. Thank you, gentlemen. Thank you so much for that, for your time. Next, with all of what you heard, with all the advice that has been given to FMDQ, with all the learnings of things that had helped the South African market, exchange traded derivatives market, and the interest rates futures market specifically grow and develop, would like to share with you all what the FMDQ exchange traded derivative market looks like. And so we're going to have the managing director of FMDQ Clear Limited, Mr. Ayodele Onawumi, present to you the FMDQ exchange traded derivatives market, which we've termed the gold standard, because we design our market, or our objective is to design the market to be globally competitive, operationally excellent, liquid, and diverse. So now please join me in welcome Mr. Ayodele Onawumi as he presents to you more detail what exactly this market we've designed looks like. Ayo.
Okay. Thank you, Jumoke. Right. Okay. Okay, thank you all, and thank you for being on this webinar again. Jumoke, can you take me to the next slide? Okay, so for us, essentially, what we're looking at is we think the landscape, and this is the perfect time to jump into providing these sorts of products. We're not unaware of our exposure as market participants, be it on the borrower side or the lender side, or even those involved in imports and exports, the exposure to various market risk factors. And as Jumoke had mentioned earlier on, one of the largest groups of fund managers exposed to interest rate risk are the pension funds, with over 9 trillion invested in federal government bonds. So we believe strongly that that group will be quite excited with this product. And I then understand why we had one of the participants bring up that question earlier on. Next slide, please. So what do we think the future should hold with the implementation of these derivative products across the various, speaking to the various market risk factors? We think overall, beyond just the stability for market participants, we also see a lot of interest here, or benefit, even from the regulator's standpoint. Overall, we believe it would help drive or facilitate foreign capital inflow as we see stability a lot more in the market. We believe strongly that it would drive market liquidity and depth as well. And of course, with the advent of these products, we will see that there will be a lot more diversified products available within the market. And as our friends from South Africa had spoken to, things around even being able to leverage your positions using these interest rate derivative products. And we think it will be something exciting for the fund managers. Next slide, please. So what are the products we have in the horizon? In the immediate term, we're kicking off with the FGN bond futures. These will be contracts listed across 4 points on the yield curve, the 2 to 5, 10, 15, 20, and 30 years. But in the short term, we would also seek to kick off the short-term interest rate futures contracts as well, looking at the much shorter end of the yield curve between 1 and 12 months. But speaking specifically to the bond futures contract, what I have here is the the contract specification. Like I'd mentioned earlier on, we have it across 6 various tenors, and essentially what would happen, and what would happen is these again will be shared with the market. But I think it's important to point out right now that in terms of the sorts of tenors we would have, when the market launches, we would have tenors for 3, 6, 9, and 12-month contracts, and maturing at predefined dates. That's March, June, September, and December. A lot has been spoken about margining. That will be done by the clearinghouse. Can you go to the next slide, please? And this, I think it's important to speak to the market framework. So essentially, we would have the trading members carrying out these, executing the trades on the FMDQ exchange, and we would have the CCP FMDQ Clear working with a group of selected institutions, which we refer to in this case as clearing members. And these clearing members would have put together some default fund or contributed to a default fund, and working with these institutions, they would represent the various trading members within the market. Of course, the CCP would novate the transactions and manage the risk associated with these transactions on a day-to-day basis. And I'll speak to how that will be done. Essentially, if in the case where they will be physically settled, the collateral would have to sit with the CSD. Next slide. And how are we carrying out this risk management? Essentially, we're addressing the counterparty risk in the market across 4 broad areas. First is the novation, which I spoke to earlier on, where we would replace all transactions in the market with a transaction with the CCP. We would, beyond that, aggregate and net all transactions to drive operational efficiency and capital efficiency. We would net all transactions, and then we will go a step further and margin. We will take an initial margin and a variation margin. The initial margin, and I heard someone speak to this earlier on, the initial margin, working with our team internally, would ensure that it's large enough to protect the CCP and the integrity of the market, but also small enough to ensure the transactions remain profitable for the various participants. On a daily basis, however, we will mark the contracts to market, and where required, do a variation margin call. Again, what all of this does is critically manage the exposure within the system and ensures the integrity of the whole market. Now, in the very unlikely event of a default, we also have a default management framework in place. There's a default risk waterfall, and it goes through right from the initial margins I have spoken to earlier on, down to the default fund contribution of the respective clearing members. The CCP resources are also available, and I had heard that mentioned earlier on as well. The CCP resources are also available, again, in the unlikely event that the default fund contribution of the defaulting clearing member is inadequate. So the default risk waterfall essentially is what we have used, or what we intend to use, to neutralize the risk within the market, and again, like I said, drive the resilience and integrity within the market. Okay, and that will be all from me. Thank you so much for listening.
Thank you very much, Ayo. Are there questions from anyone on this part of the presentation? Please feel free to use the question and answer box to put forward your questions. None so far, so good. So thank you very much. Apologies, I didn't realize my video wasn't on. Thank you very much for that, Ayo. Thank you for your time. So if there are no questions, to summarize, what we've heard from our counterparts in South Africa, and even from a corporate treasurer operating here in Nigeria, is without a doubt, the benefit of the introduction of exchange-traded derivatives cannot be argued. And what is the use of that product have numerous benefits: cost efficiency, capital efficiency, ease of being able to execute and manage your transactions, and ultimately, of course, risk management in the in whatever economy or whatever field you find yourself in. But of course, as we've heard from each and every one of them, is always understand the product you're going into, and be prepared for what you would experience when you use the product. And that's the reason why we've had series of training sessions and sensitization sessions, and even such a webinar as we're having today for various participants in the Nigerian financial markets ahead of the launch of the FMDQ exchange traded derivatives market. We quite understand that important factor of educating everyone on the use of the product. So we hope you have gained from this session. We hope this, starts up further conversations within your organizations. If there are further information you require, please reach out to us. We have a poll that we'd just like you to please help us with very quickly. It should have popped up on your screen. Please help fill the poll. But we hope that as you go along, please feel free to reach out to us if you have any further questions or require further details about the market and how your organization in the institution can come into play. We're very much available and on standby to educate you further on this. Feel free to send us suggestions on further things that you think we can do to help make the activation and launch of this market successful. And I send back the charge to my pension funds in the house. Join us and let's jointly engage the Pension Commission for the use of these products in your markets. So the poll are still on. I'm just going to give 1 minute, about 30 seconds for additional responses to please come in. Please help us fill the poll. Your feedback is most important and useful. You've been with us an hour and a half. It'll be useful to make sure that we've utilized your time very well. All right, on behalf of the management of FMDQ Securities Exchange Limited, I'd like to say thank you so much for giving us your time this morning into afternoon to listen to us on the applicability of exchange traded derivatives for investment, treasury and investment management, a global market perspective. And we encourage you to look out for more of such sessions, which the FMDQ Exchange is going to be introducing and running as the period goes by. Thank you very much, everyone, and do enjoy the rest of your day.
Thank you.
Thank you, everyone.